Okay, so now we're still lecture week 3. Now we're in the second part of this lecture, and we still need a little more background. We still need a little more background before we get into discussion about the earned income tax credit per se. And here we're talking about the relevance of taxes to low-income populations. So I think this is sort of an intuitive argument. I'm running through here in this slide different ways in which taxes might affect low-income populations. And I'm sure you can reel off, just off the top of your head, different ways in which low-income persons might be affected by taxes. So certainly the revenue that we generate through taxes is going to have an impact on low-income populations with the programs that we operate. The type of tax will matter. So if we're advocating on behalf of low-income populations, we certainly want progressive taxes that are more favorable for the lower-income populations. And of course, tax credits will matter. And as we'll see when we get into discussion of the earned income tax credit, the type of tax credit will matter. So I think this is pretty much a slam dunk case in terms of how tax credits affect low-income populations, that they do in fact affect low-income populations, and so it's a justification for our study of this topic. So more terminology here about how the federal income tax structure works before we dive into the EITC, the tax credit. Before we start even thinking about the tax credit, this is just some background about how the tax system works. This is from the federal government. We're talking about the federal tax structure. And I noted before that we have a graduated income tax structure, that it's an example of a progressive tax. So let's imagine as a starting point that you have someone who's working, a low-income person who's working, and they get a paycheck. That's their gross income, right? So they get some gross income. And so once they have their gross income, they're going to have to file taxes every year just like anyone else. So in April, we file our taxes annually to the federal government. And so as part of that filing, whether you've filed taxes before or not, maybe your parents have done it for you, they file their 1040 or their 1040 easy forms. And as part of that tax accounting, there's something called exemptions and deductions. So the way those things operate, those exemptions and deductions, those are basic reductions in the amount of income that the federal government will look to when they calculate your tax, right? So it effectively reduces your taxable income when they calculate your tax. That's how they work. So first we have an exemption, and the exemption is based on the number of people in your filing unit. So if you have one person, if you're filing as a single individual, you're entitled to one exemption. And so for each exemption, you have a reduction. You're entitled to a reduction in the amount of $3,900, I note here, right? And so that's for one exemption. If you're a single mom and you have one child, you have one dependent, you're most likely going to file as a head of household. You have two people. You have two people in your filing unit. Remember, the exemptions are based on the number of people in your filing unit. You have two people in your filing unit. So you're entitled to exemption in the amount of $3,900 multiplied by two. So that's $7,800 in the way of an exemption if you have two people in your unit, and so forth. If you have two kids, you have three people in your filing unit, and so 3 multiplied by 3,900, you'll have an exemption in the amount of $11,700, right? So this is your first reduction that you're entitled to, given your gross income. Now, we have another reduction here, and that's the standard deduction. We're all entitled to standard deductions, and this is not based on the number of people in the filing unit, but this is based on the type of filing unit. So you note here that this depends on whether you're filing as a single individual or as head of household, or if you're a married couple filing jointly. So if you're single, you're entitled to standard deduction in the amount of $6,100 as of 2013. These amounts change every year, but that's a standard deduction. And you note here that if you have dependents, if you're a mom, you have a child, or maybe you're a worker and you have parents you're taking care of, either way, you might file as head of household because you have a greater reduction here, $8,950 if you file as head of household. And one of the benefits, presumably, to being married in our society is that you have a greater standard deduction. You note here that the deduction is $12,200. Now this is a benefit that accrues to gay couples now. Our tax code now recognizes gay marriages, so you're entitled to this standard deduction in the greater amount for your gay partner, for your partner. Right, so we have one other type of deduction here. That's a calculated deduction. You may have heard of people talking about tax write-offs, right? They have so there's a lot of discussion in the last election about how Mitt Romney pays so little in the way of taxes. Well, it's partly because of the tax write-offs, right? The tax loopholes, or more formally, we call it the calculated deductions. So this entitles you to further reductions in your taxable income if you spent on certain items, right? Your tax loopholes. So examples of calculated deductions, there are certain activities that the government will incentivize, right? So if you've made contributions to a charitable organization, to a nonprofit, in other words, a 501c3, you can deduct that from your income, from your gross income, for tax calculation purposes. If you were to take a job in California, for example, you could claim your moving expenses. You could reduce your taxable income by the amount of your moving expenses. So they're different. If you have hospital expenses, you could deduct your hospital expenses. Excuse me. So there are different types of expenses for which you could further reduce your taxable income. And so these are your calculated deductions. Now I go through all that because once you figure your exemption amount, your standard deductions, and maybe some tax loopholes, you want some calculated deductions, you've come to your taxable income. The amount of income that the government will count when figuring your tax liability, when figuring the amount of taxes that you owe, in other words. And so once the government figures your taxable income, your adjusted gross income, your adjusted income, then they'll figure your tax liability, what you owe in the way of taxes. So the relevance here is that the tax credit doesn't even kick in until you figure out what the tax liability is, or the amount of money that you owe in the way of taxes. Now, for low-income populations, a tax liability is very minimal, if there's any liability at all that accrues to individuals. And so, which brings us to the type of tax credit, whether a refundable tax credit or a non-refundable tax credit. Which one is more important? Of course, intuitively, the refundable tax credit is going to be much more favorable for the low-income worker, because typically low-income workers have very little to no tax liability. So you can imagine if you want a reduction in your tax liability via tax credit, you want that money to come back to you because you're not going to owe anything typically. In other words, you have negative tax liability. And so the tax credit, a refundable tax credit, is certainly much more favorable for the low-income worker, whereas the higher-income worker, the tax credit, because you typically owe more in the way of taxes, doesn't matter if it's refundable, non-refundable, you're going to have a reduction in your tax liability if you're a higher income worker. And so taken as a whole, so all of these concepts taken as a whole, we note that exemptions and deductions will reduce your taxable income, the amount of income that the government takes into account in figuring the amount of taxes owed. But then the tax credit is relevant when we're talking about tax liability. It's applied to your tax liability, or the amount of taxes that you owe. That's when the tax credit becomes relevant. Now, I noted before that the federal income tax is an example of a progressive tax. So this is a more specific representation here that I show in this schedule in terms of a progressive tax. So this is our federal income tax structure for 2013. And these are your tax brackets, your marginal tax rates. And by marginal tax rate, what I'm referring to here is the tax rate on the next additional dollar of income. Right, on the next additional dollar of income. And so you'll note here that the first tax bracket is 10%, the next bracket is 15%, and you have 25% and so on. So what that means is that on the first dollar that you've earned in the way of taxable income, you're going to owe 10 cents on that first dollar in the way of a tax. On the second dollar, you owe another 10 cents. On the third dollar, you owe another 10 cents, all the way up to $36,250. That's the bend point. At that point, you're going to owe a tax rate of 15% or 15 cents on each additional dollar. So on $36,251, you're going to owe 15 cents. On $36,252, you're going to owe another 15 cents, and all the way up to the next bend point, all the way up to $87,850. At which point you'll start owing 25 cents on each dollar, and so you'll see those bend points there. Okay, so these are marginal tax rates. This is the tax rate on the next additional dollar earned. And let me just clarify something. I think I just skipped something, but within this within this region, between 8,925 to 36,250, you're at the 15% rate, and between 36,250 and 87,850, that you're at the 25% tax bracket. Just to clarify things. All right, so I give you an example here. Not to test your math ability, but just to illustrate what these terms mean. And so I can't think of any better way to show you what these terms mean by going through the calculation just once at least, to show you what these terms mean. So I'm taking here a single taxpayer. You have a single taxpayer with no kids, and this person has taxable income of $50,000. And by taxable income, I note here that this is after exemptions and deductions. So recall we talked about exemptions and deductions. We've applied the exemptions. This person is entitled to one exemption, right? Because there's only one person in the filing unit, and this person is filing as a single individual. So this person will claim at the lowest level of a standard deduction. And so after all those things are taken into account, we note that this person has $50,000 of taxable income. And so the basic exercise here is in trying to figure out what this person owes in the way of taxes. That's what we mean by tax liability. Okay? And so we note that on the first $8,925 of taxable income, this person is going to owe 10% of that amount. And in parentheses, you note, I'm noting here the actual amount of taxes owed. And on the next $27,325. So in other words, the difference between $36,250 and $8,925, this margin here, this person will owe 15% tax rate. And so that amount comes out to $4,098 and some change. And then on earnings, on taxable income that exceeds $36,250 all the way up to $50,000 of taxable income, this person is going to be at the 25% tax rate. And so that amount will come out to $3,437,000. And so you note here that the $13,750 is just the difference between $50,000 of taxable income and this bend point of $36,250. I took that difference, and I note that this person owes 25% tax, and so that's the amount. And so if you add all of that up, getting back to the big picture, if you add all of that up, this person is going to owe $8,428.75 in the way of tax. So the tax liability, in other words, is $8,428.75. Now, a quick note here before we move on to discussion of the earned income tax credit. I distinguish here between marginal and actual tax rate. So I noted before that this person's marginal tax rate, this person is in the 25% tax bracket, right? This person is in the 25% tax bracket because of the $50,000 of taxable income puts them within this region, right? And so this is a 25% tax bracket that this person is in. But if you want to know how much this person is actually paying, it's not actually 25% because of the margins, the marginal tax rates, the marginal taxes that we calculated. And so that's the point here. That's the only thing that I'm really trying to distinguish here. The actual taxes paid, we noted, was $8,420.75. If you take that amount as a percentage of the taxable income, the total taxable income, this person ends up paying 16.86%. Right? So that's the actual tax rate. That's distinguishable, of course, from the marginal tax rate. This person is in the 25% tax bracket, but ends up paying 16.86%. Okay? So when you hear talk about Mitt Romney, despite his high level of earnings, that his actual and marginal tax rates are much different. He's in the highest tax bracket. He's in that 39.6% tax bracket, but he's only paying 20-some%. That's what we're talking about, distinction between actual and marginal tax rates. So this is just a quick exercise of all the concepts, of all the tax concepts that we've covered up to this point. And so I'll let you run through this exercise on your own. And then, of course, during our face-to-face meeting, we'll see what you guys have come up with for this. And so in the next section, we'll dive into the earned income tax credit and see how that program operates.